Condo sales in some major Canadian markets are continuing to drop to lows not seen in decades.
In November 2025, Toronto realtor David Fleming pulled up a floor plan for a 267 square foot condo and said something that stopped people cold. He said you could probably open the fridge with your toes from your bed. That's not an exaggeration. That's the actual size of thousands of shoebox condos built across Toronto. According to Statistics Canada, investors owned 65% of Toronto's smallest condo units, the ones under 600 square feet. These weren't homes. They were investments. And for years, the model worked perfectly. Developers built them. Investors bought them in pre-sale. Prices climbed. Rents climbed. Everyone made money. But in 2024, something broke. CIBC and Urbanation Research revealed that 81% of investors who bought newly completed shoebox condos were losing money every single month. Not a little money. An average of $605 a month just to keep the lights on. And prices started falling fast. This is the story of how Toronto's shoebox condos went from the smartest investment in real estate to a financial trap that's quietly destroying portfolios across the city. For over a decade, Toronto developers had a formula that seemed unstoppable. Build the smallest units legally allowed. Pack as many as possible into each tower. Sell them to investors before construction even started. David Fleming explained it bluntly in his November 2025 interview with CBC. These 267 square foot units were only built so that an investor could buy them, so the developer could get pre-construction financing. That's why they exist, not for people to live in. For developers to hit their 70% pre-sale threshold and get bank funding. According to a 2024 report, 65% of Toronto's smallest units under 600 square feet were owned by investors. Compare that to larger units over 800 square feet, where only 44% were investor-owned. The shoeboxes were the investment play. Cheap to buy in bulk, easy to rent to international students or temporary workers. For a while, the math worked perfectly. Buy a 267 square foot unit for $350,000 in 2018. Rent it for $1,800 a month. Sell it in 2021 for $450,000. Pocket $100,000 plus rental income. Do that 5 times, and you're a millionaire on paper. Nobody questioned whether a 267 square foot box with a pull-out couch was actually a viable long-term housing solution. But in 2022, interest rates spiked, and the entire shoebox model collapsed overnight. The Bank of Canada started hiking rates in early 2022. They went from near zero to over 5% in less than 2 years. For shoebox investors, that change was devastating. A typical $400,000 shoebox condo mortgage jumped from $1,500 a month at 2% to $2,300 at 5.5%. Add in $500 for maintenance fees and $200 for property taxes. Total carrying cost hit $3,000 a month. Meanwhile, rents for shoebox units started falling. According to LiveRent, the average rent for unfurnished one-bedroom units dropped $300 between October 2023 and October 2024. Shoebox units saw even steeper declines because there were too many of them. The tenant pool dried up fast. Canada Mortgage and Housing Corporation reported that net newcomers to Canada dropped from 1.4 million in 2023 to under 300,000 between late 2024 and mid-2025. That's an 80% collapse. International students got capped. Temporary workers stopped coming. By July 2024, CIBC and Urbanation published research that exposed just how bad things had gotten. They found that 81% of investors who bought newly completed shoebox condos were cash flow negative. They were losing an average of $605 every single month. 8 out of 10 shoebox investors were bleeding over $600 monthly just to keep a unit they couldn't sell and could barely rent. Sales collapsed completely. In September 2025, only 53 new condo units sold in all of Toronto. That's not 53 shoeboxes. That's 53 total units across the entire city in a full month. By the end of 2025, Urbanation reported that developers sold just 1,599 new condos for the entire year. That's a 95% drop from the 2021 peak. Before we dive into just how bad the financial damage is for Shoebox owners, if you're following Toronto real estate, hit that subscribe button. We break down the numbers nobody else is tracking and show you what's actually happening in markets. All right, let's talk about the money investors are losing right now. Take a typical 400 square foot unit at $400,000. Monthly reality, $1,530 mortgage, $450 maintenance, $180 taxes. Total $2,160. Average rent sits around $1,800. You're losing $360 monthly before repairs. That quickly becomes $500 or $600 with reality. Rents for small units fell 2.8% year over year in Q1 2025. Listings up 29%. Too many shoeboxes chasing too few tenants. A $450,000 shoebox costs $2,400 monthly to carry. Rent it for $1,900. You're bleeding $500 a month. $6,000 annually holding a depreciating asset. Even at 3.25% interest, investors lose over $400 monthly. To break even, you'd need 1.1% rates or $280,000 purchase prices. Neither is happening. Investors who bought pre-sale in 2020 to 2021 at peak faced brutal choices at closing. Walk away and lose $100,000 deposits, or close and bleed $800 to $1,000 monthly, hoping for recovery. Most chose to hold. Selling meant locking in six-figure losses immediately. Developers started canceling shoebox projects. In 2025, 28 condo projects were canceled. Over 7,000 units that will never get built. Construction starts collapsed to levels not seen since the 1990s. Only 2,540 new units broke ground in Toronto through September 2025. The 10-year average was over 12,000 annually. That's an 80% drop. Banks require 70% of units pre-sold before releasing financing. In early 2025, 55% of pre-construction units sat unsold. Developers couldn't hit pre-sale thresholds because investors backed off completely. Only 17% of new condo launches sold in the second quarter of 2024, lowest in nearly 30 years. Shoebox units struggled the most. Investors who used to buy 5 or 10 units at a time disappeared. They looked at the math and saw $600 monthly losses with zero appreciation. The carry trade was dead. The fundamental problem: micro units with 3 or fewer rooms represent 60% of all new condos hitting Toronto. But only 30% of households actually want those tiny units. Developers built what investors would buy, not what people needed. Delphine Winton, a 22-year-old student, told CBC she actively avoided new buildings. She wanted older buildings with actual kitchens and dining space. She looked at shoebox floor plans and said, "God forbid you have enough room to put a dining table in." Families don't want 267 square foot shoeboxes. Young professionals don't want to eat, sleep, and work in 400 square feet. Even single renters walk away because layouts are impractical. 55.2% of Toronto condos built from 2016 to 2020 were investment properties, never designed for people to live in long term. David Fleming said if the city banned 267 square foot condos tomorrow, nothing would get built. Investors wouldn't buy bigger units at volumes needed to hit pre-sale thresholds. Broken cycle. Developers need investors. Investors want cheap shoeboxes. End users don't want shoeboxes. Prices fall. Sales collapse. The machine stops. As of early 2026, shoebox investors are trapped. Prices for units under 600 square feet have dropped faster than the broader market. For investors bleeding $600 a month, the outlook is brutal. Even if interest rates drop to 3%, most shoebox owners would still be cash flow negative. Economists forecast rates will only decline to about 2.25% by year-end. That's not low enough. Rental demand keeps falling. Immigration targets dropped. International student caps kicked in. The tenant pool that filled these tiny units shrank by 80% in 2 years. Unlike previous downturns, this demographic isn't coming back quickly. The broader Toronto condo market hit 34-year sales lows in 2025, but shoebox units got hammered the hardest. First units investors dumped. Last units buyers wanted. The era of flipping pre-construction shoeboxes is over. Thousands of investors are stuck holding assets that lose money monthly while values keep sliding. Some are considering walking away from deposits entirely rather than closing on units worth $100,000 less than they agreed to pay. Here's the twist. The collapse destroying shoebox investors today creates tomorrow's housing shortage. Construction starts dropped 80%. Condo towers take 3 to 5 years to build. By 2027 and 2028, Toronto could face a severe supply crunch. But for anyone holding a 267-square-foot shoebox now, that future shortage doesn't help. You're losing money today. Your unit is worth less than you paid. The rental market isn't strong enough to bail you out. Toronto's shoebox condo crisis exposed a fundamental flaw in how the city built housing for over a decade. Developers designed units so small you could open the fridge with your toes from your bed. Investors bought them in bulk without ever planning to live there. And when interest rates went up and immigration slowed, the whole system collapsed. Right now, 81% of shoebox investors are losing over $600 a month. Sales hit 34-year lows. Construction stopped. And the units that were supposed to be the safe entry point into Toronto real estate became financial traps. For anyone who owns a shoebox or is thinking about buying one, the numbers don't lie. Negative cash flow is the standard. And those 267-square-foot units that once seemed like smart investments are now the clearest example of what happens when a market loses touch with reality. The shoebox market crashed faster than anyone expected, and nobody knows when it's going to stabilize.